Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 8 titled Covered Call Writing Risk Reduction. We're going to analyze protective puts, which in conjunction with covered call writing is known as the collar strategy, and we're going to analyze using in-the-money call strikes. Both of these are approaches to risk reduction in our covered call trades. Now, when we add a protective put to our covered call trade known as the collar, we are in 3 positions. We're long the stock. We first buy a stock. Then we're short the call option, the out-of-the-money call option, which is our covered call trade. Long stock, short call. To that, we're adding a long put. We're buying a protective put. In essence, we're having a ceiling on this trade in the strike price of the out-of-the-money call and a floor on the trade with the out-of-the-money put strike. So those are the 3 components to the collar. Now we're going to compare that to selling in-the-money call options. Now, in-the-money call options have an intrinsic value component to it. Only in-the-money call strikes have an intrinsic value component. So since we have an intrinsic value and a time value, we're lowering our cost basis to a greater extent, and therefore we're lowering our break even. So there's more risk reduction within the money call strikes than there are with at the money or out of the money call strikes, neither of which have an intrinsic value component. Now, to analyze these approaches to risk reduction, we're going to use a real-life example with Centene Corp., which trades on the New York Stock Exchange under the ticker symbol CNC. At the time that I'm making this video, CNC is trading at 71.27. Okay, so we're buying the stock at 71.27. Let's first look at the covered call strike, and we're going to go out of the money to the 72.50 out of the money call strike. And if we look at the bid column, we'll see that generated a premium of $3.90. That's our covered call trade. Now, if we also bought a protective put out of the money, which is lower than current market value, we're going to analyze the 65 out of the money put, which required an ask price of $255. And if we wanted more protection, we would use the 67.50 put, which required a premium of $320. So those are the prices we'll analyze in the BCI collar calculator for the collar trades. The out of the money 72.50 call strike and the out of the money put strikes of 65 and 67.50. We're going to compare that to writing a covered call, not with an out of the money call, but with an in the money call strike. And we're going to analyze those same 2 strikes that we looked at for the put, 65 and 67.50, both in the money or lower than current market value. Now, the bid price on the 65 in the money call was $850, and the bid price on the 67.50 in the money call was $680. Now, we feed this information regarding the collar trade, and we'll have a separate calculation for the in-the-money call strike. But for the collar trade, we're going to use the BCI collar calculator, and there are white cells on the top where we feed in the information. So let's start with the purchase price of $71.27, the out-of-the-money call strike of $72.50, and we're going to look at the out-of-the-money put strike of $67.50. So the call strike generated a premium of $390, and for the put strike, we paid $320. Okay, so if we look at the in the green cells below the white cells, and for those of you just listening to the podcast, I'll explain it and describe it to you. The net trade resulted in with the 67.50 strike, 0.98% 1-month return. Now, if the price of the stock went up to the 72.50 call strike, our 1-month return would be 2.71%. That annualizes out to 34%. Now, what if we use the 65 deeper out of the money put strike, in other words, less protection, and that costs less, $255, as opposed to $320 for the 67.50 put. So we're spending less money. Therefore, our initial premium would be higher, 1.89%. But what if that if the price of the stock goes up to the 72.50 out of the money strike, that would give us a 1 month return of 3.62%, which annualizes out to 45%. Okay, all that's the good news. But what if the price of the stock drops below the put strike? Well, in the case of the 67.50 put strike, we have a 1 month loss of 4.31%. In the case of the 65 deeper out of the money put strike, we have a higher loss of 6.90%. Okay, so there you have various scenarios where, depending on the price of the stock at expiration, will dictate a premium as high as 2.71% for the 67.50 strike on the put side, or as low as minus 4.31%. And for the 65 put, we have returns as high as 3.62%, but as low as minus 6.90%. But if the price of the stock gaps down well below the put strike, we still have the ability to sell at the put strike. And that is one of the main advantages of the collar strategy. Now let's have a look at the in-the-money call calculations. We're using the Ellman calculator for that. And if you recall, CNC was trading at 71.27. The 65 in-the-money strike generated a bid of 850. And the 67.50 in-the-money strike generated a premium of 680. Now, you have to remember that the intrinsic value has to be deducted from the premium to get our initial time value return, which is on the calculator spreadsheet is known as the ROE, or return on our option. So for the 65 strike, the return is 3.4%. Remember, that's for 1 month. And for the 67.50, the return is 4.5%. The main advantage of the in-the-money strikes, though, is the protection you get to the downside. So the downside protection, which means how much the price of the stock can drop while still retaining that initial time value return, for the 65 strike is 8.8%. That means we are guaranteed a 3.4% 1 month return as long as share value does not decline by more than 8.8% in the next month. Now for the 67.50 in the money strike means we are guaranteed a 4.5% 1 month return as long as share value does not decline by more than 5.3% by expiration. So you see the great advantages to writing in the money call options, especially in a bear or volatile market. But remember, these strikes only protect us down to the break-even point. If it starts dropping below the break-even point, we start losing more money. With the collar, that's not the case. When it drops to the put strike, it keeps going lower, we stop losing money once it drops below that put strike. Let's talk about a comparison of these two approaches. For the collar, it protects us against major gap downs. That's the big advantage to the protective put. It can drop to zero, and we still have the ability to sell the stock at the put strike. In the money calls protects us only to the break even. So it still gives us lots of protection, but not nearly as much as the protective put. Now, the protective put costs money and therefore reduces profit. For the in-the-money call option, that's paid for by the option buyer in the form of intrinsic value. Big advantage for selling in-the-money call options in terms of risk reduction. Now, on the collar side again, these protective puts will expire, which means we have to repurchase them. So we're constantly spending money to protect or reduce risk on the covered call trade. Whereas for in-the-money calls, we're getting new insurance for free every time that in-the-money call option expires in the form of intrinsic value. Now, on the collar side of an advantage is that we can participate in share appreciation from current market value up to the out-of-the-money call strike. When we sell an in-the-money call, there is no upside because we're agreeing to sell our shares at the start of the trade for a lower price than current market value. Now, for collar, when we buy a protective put, we are raising our cost basis, the cost of the put. When we sell in-the-money call options, we are lowering our cost basis even further by the form of intrinsic value. So as you can see, each approach does reduce risk, and each has its strengths and weaknesses. So let's summarize. Risk reduction for our covered call trades can be accomplished in many different ways. Two of these approaches involve buying protective puts and writing in the money call options. Protective puts protect against gap downs below the put strike, but they do cost money. In the money call options are paid for by the option buyer, not by us, the option sellers, in the form of intrinsic value. But it'll eliminate any possibility of taking advantage of share appreciation. So once again, pros and cons, strengths and weaknesses. Now, for those of you who do not already have the basic Ellman calculator, you can get a free copy. Just go to our website, www.thebluecollarinvestor.com, and look at the black bar at the top of all the web pages. Just click on free resources, including the Ellman calculator, and you can download the device and its user guide right to your computer or whatever device you're using. Those of you interested in the collar strategy, we have additional educational products in our BCI store. The book is called Covered Call Writing Alternative Strategies. Section 2 is dedicated to the collar strategy. We also have a DVD program. It's an online streaming DVD program where you can download the workbook. That's also located in the BCI store. And finally, we have a collar calculator, a spreadsheet that will do the calculations that we demonstrated, we talked about before in this podcast. All those located in the BCI store. So there you have it, ladies and gentlemen. BCI podcast number 8, Covered Call Writing Risk Reduction. I hope you enjoyed this podcast, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.